Silver
just smashed through $117 per ounce, an all-time high.
Gold
Has breached $5,500, entering completely uncharted territory. And yet, Bitcoin, the asset we were told was the digital gold, the hardest money ever discovered, is struggling to hold $90,000. In fact, it is down over 30% from its October peak. The charts tell a shocking story. While the shiny rocks that our ancestors used as money are skyrocketing, the future of finance is bleeding out. Why is the hardest asset on Earth losing to physical metal? Is the digital gold narrative dead? Or are we witnessing one of the greatest bear traps in financial history? The answer lies in a divergence that few people are talking about. It involves a geopolitical crisis in Greenland, a massive rotation in institutional capital, and a structural supply deficit that could send silver even higher. But, most importantly, it involves a historical cycle pattern that suggests Bitcoin's current lag isn't a sign of weakness. It's a signal for what's about to come. My name is Nick, and you're watching The Coin Bureau. Before we begin, I am not a financial advisor, and nothing in this video is financial advice. It's just educational content intended to help you understand the macro forces shaping your portfolio in 2026. If that sounds good to you, smash that like button and let's get stuck in. First things first though, we need to look at the raw data because the divergence we're seeing right now is mind-boggling. If you've been watching the markets since the start of the year, you might feel like we're living in the twilight zone. Let's look at the numbers. According to the charts, silver didn't just have a good year in 2025, it skyrocketed 150%. And year to date in 2026, it's already up another 55%. Gold, the boomer rock that crypto Twitter loves to mock, surged 65% in 2025 and has continued its relentless march upward, currently trading above $5,000. Meanwhile, Bitcoin crashed from an all-time high of roughly $126,000 in October 2025 to around $88,000 by late January. And that's a brutal 30% collapse during the exact same period that precious metals were hitting all-time highs. If Bitcoin is supposed to be a safe haven, why is it trading like a tech stock that's in the middle of a recession? Well, to put things into perspective, we need to talk about the safe haven narrative. Because right now, that narrative is being tested like never before. When geopolitical tensions flare, whether it's the dispute over Greenland, the escalating tariff wars, or the fears of a US government shutdown, capital has a choice. It can flee to assets with 5,000 years of history, or it can flee to an asset with 15 years of history. And in late 2025 and early 2026, fear chose 5,000 years. The Greenland crisis specifically has rattled markets more than most people actually realize. When you have major geopolitical powers posturing over territory and resources in the Arctic, the uncertainty drives institutional money into the deepest and most liquid defensive assets available. And right now, that is gold. During the peak of the crisis panic in late 2025 and early January, we saw days where nearly $500 million exited Bitcoin ETFs in a single session. In total, Bitcoin ETFs hemorrhaged roughly $6 billion from late 2025 through early January 2026. But here is where things get interesting. That money didn't just disappear, it rotated. While Bitcoin ETFs were bleeding, gold ETFs globally attracted a staggering $89 billion in inflows throughout 2025. Capital isn't leaving the markets, it's rotating from digital to physical. Institutions faced with regulatory uncertainty from the Stalled Clarity Act and looming tax loss harvesting deadlines decided to park their wealth in the asset class that has survived every empire in history. And this begs the question, is Bitcoin actually a safe haven, or is it still just a risk asset? The uncomfortable truth is that Wall Street still treats Bitcoin like a high-growth tech stock. Bitcoin's correlation with the S&P 500 remains stubbornly high, sitting around 50% to 80% depending on the time frame. Meanwhile, its correlation with gold is at multi-year lows, hovering near zero. When the Nasdaq bleeds, Bitcoin bleeds. Until institutions formally reclassify Bitcoin as pristine collateral, as something that is beginning to happen with the CFTC's pilot programs but isn't fully operational, Bitcoin remains trapped in what we call the risk asset purgatory. But there's another factor at play here, specifically regarding silver. And this is something that the digital gold simply cannot compete with: industrial demand. Silver's rally is structural, not just speculative. Industrial demand for silver hit a record 680 million ounces in 2024, and that is nearly 60% of total global demand. Why? Well, because of the green energy transition and the AI boom are both built on silver. Now take solar panels, for instance. Each unit contains approximately 20 grams of silver. Battery electric vehicles, meanwhile, can consume up to 50 grams of silver each, twice as much as traditional combustion engines. But the real kicker is the AI data center boom. We often hear about the energy needs of AI, but we rarely hear about the physical infrastructure. To power these massive hyperscale data centers, companies are building a massive array of solar panels. A single 500 megawatt solar array, the kind needed to power one of these AI behemoths, requires somewhere between 5 and 12.5 metric tons of silver. Silver backs the AI boom. Silver backs the energy transition. Silver backs electrification. Bitcoin backs a monetary network. Now, don't get me wrong, that monetary network is valuable, but when fear dominates and industrial engines are revving up for a wartime protectionist economy, physical utility matters. And this is compounded by the fact that we are in the 5th consecutive year of a structural supply deficit in silver. We've burned through over 800 million ounces of cumulative deficit since 2021. The vaults are draining, and that is why silver is smashing all-time highs. So, does this mean that you should sell your Bitcoin and buy silver? Well, before you do anything rash, you need to understand the rotation theory. Because if history is any guide, the metals rally might actually be the best leading indicator for Bitcoin that we have. But before we get into that, you need to make sure that you aren't overpaying on fees when you do decide to make your moves. And that is why you should check out the Coin Bureau Deals page. Whether you're looking to trade crypto, gold, or stocks, we have negotiated exclusive sign-up bonuses worth up to $100,000, trading fee discounts of up to 50%, and deposit cashbacks with the best exchanges in the industry. Just hit the link in the description or scan this QR code on the screen. Now, these deals won't be around forever, and in markets moving this quickly, every single basis point counts. So, scan the code on the screen, grab the bonus below, and let's get back to the charts. Now, if you were paying attention earlier, you'll recall that I mentioned the rotation theory. History shows a distinct pattern in liquidity cycles. Metals pump first, and then Bitcoin pumps. Analysts have actually observed that gold typically leads Bitcoin by roughly 3 to 7 months. Now think back to 2020, for example. Gold hit an all-time high in August 2020. Bitcoin didn't start its parabolic run until late Q4 of that year. The lag is real. If this cycle holds, Bitcoin's current stagnation isn't a sign of death. It's simply a timing mismatch. The massive rally in gold and silver that began in late 2025 could be setting the stage for a violent Bitcoin breakout in Q2 of this year. Why Q2? Well, that's because that is when the macro environment is expected to shift. Right now, the market is pricing in the Federal Reserve resuming rate cuts around June 2026. When rates come down, liquidity expands, and when liquidity expands, capital rotates out of defensive havens like gold into faster horses like Bitcoin. The current divergence is frustrating, yes, but it is also mathematically consistent with previous cycles. And here is the news flash that bears are ignoring. While retail investors are panic selling because Bitcoin dropped 30%, larger investors have been buying the dip. And one example here has been Strategy. During the so-called weakness of Q4 2025, Strategy didn't sell. They accumulated a staggering $20.5 billion worth of Bitcoin. And they didn't stop there. In a single week in early January 2026, while the ETFs were bleeding, Strategy scooped up another $1.25 billion. And they aren't the only ones. On-chain data shows that the average cost basis for Bitcoin ETF investors sits right around $84,099. This is a critical level. It represents a historical support zone where institutional money has drawn a line in the sand. We've seen Bitcoin bounce from this region multiple times because the institutions that allocated billions at this price point are not day traders. They are allocators. They are defending their entry. So, what is the catalyst that closes the gap between gold and Bitcoin? It comes down to two things: the Fed and the Clarity Act. We already mentioned that the Fed is expected to cut in Q2, but the regulatory piece is just as important. The Clarity Act, which has been stalled in legislative purgatory, is causing massive uncertainty. Institutions hate uncertainty, and they love gold because the rules of gold don't change. But if we get clarity, if the stalled legislation finally moves forward, potentially later this spring, that regulatory risk premium evaporates. And when it does, Bitcoin's risk-on properties combined with its hard money properties create a perfect storm for the upside. And this brings us to the verdict. Is the digital gold narrative broken?
Is it?
Is it? No, it's just paused. You have to remember that gold has a 5,000-year head start. It is the ultimate break glass in case of emergency asset. Bitcoin has been around for 15 years. It's still a teenager. It behaves like a teenager, volatile, moody, and occasionally brilliant. But if liquidity expands and currency debasement accelerates in 2026, which seems inevitable given the debt levels, Bitcoin's fixed supply becomes the ultimate asymmetric bet. The lag we are seeing is frustrating for holders. I get it. Watching silver moon while your Bitcoin portfolio bleeds is painful. But marathons aren't won in the first mile. The metals are sprinting ahead because the gun just went off for the hard asset cycle. Bitcoin is still lacing up its shoes. The opportunity here isn't to chase the asset that has already pumped 150%. The opportunity is to look at the asset that is most likely to catch up. And Bitcoin plays the long game. Patience will be rewarded. So, are you rotating into metals, or are you using this dip to stack more sats? Let us know in the comments down below. And if you want to know which specific altcoins might benefit when that rotation finally hits, check out this video right over here. Okay, thanks for watching, and I'll see you again soon. This is Nick, signing off.